Thanks so much for tuning into this very special conversation. It always helps to understand what some of the large money managers are thinking about the markets, especially at a time when we nudged 20,000 on the Nifty, and there has been a sharp rally both in the large cap and the broader end of the market to do that. As of course, as things stand in today's session, the broader end of the spectrum is getting sold off as well. So that is the other layer. But it's not just about what's happened in today's session, but what about could happen in the times to come. Is the conversation with a very special guest today, Prashant Khemka, White Oak AMC Johnson, right now on the show. Prashant, so good having you. Thank you so much for taking the time out.
My pleasure, Niraj. Thanks for having me on your show.
No, the pleasure is ours. Prashant, in some fashion, yes, it's a milestone or a pit stop, but it's an important one. A recognition of the fact that there is money flowing into India, both domestic and global. Where do you think life takes us from here?
Certainly, it's always exciting, every milestone, 5,000, 10,000, 20,000. But all these milestones are to be, expected. It's like there's this saying in sports, right? All records shall be broken. Similarly, all heights shall be scaled in market, or all targets shall be achieved. And we have to understand every thousand becomes that much easier, because 1,000 points on 5,000 is 20%. 1,000 points on 20,000 is 5%. So it is very good. I think we would see, obviously, the years to come. It's almost mathematical, Neeraj, to us. As long as you agree that the real economy can grow at about 6%, and GDP deflator is about 4-5%, that means normal GDP is growing at about 10%. And historically, in most markets, including in India, if you look at over a very long time period, the markets have gone higher. If you look at just the price index, so in 19, I know going way far back, but Sensex was the only index back then when I, as a retail investor, got sucked in. So from 275 ka Sensex, it's come to some 67,000 in 38 years. So every 7 years, you can assume they are going to double. Is a reasonable assumption. So within, one can put any target on the market that would look absurd today, but then at a 10% compounding, Nifty would get to 2 lakhs, within the next couple decades or so. So looking forward, we all hope to, enjoy these different milestones together going forward. And that is just representative of an economy growing at a healthy pace of 6% in real terms.
Wow. I wrote a column called Ab Ki Baar Nifty 50,000, and I thought I was being, am I being too optimistic? Though it was, again, as you said, based on math, nothing
10
else.
years. Give it 10 years, 50,000.
Yeah. Which is what...
By that math.
By that math. Yeah. That's what I've...
We'll celebrate together.
Cross fingers for all of that and more, Prashant. Yes. Okay. So that's the longer term picture. The short term, Prashant, and a lot of people will say that, see, I told you so, because the mid caps have kind of come off today. Yesterday, there was this Kotak note floating around which spoke about how they've taken recommendations off because they thought there was too much froth out there. And my question is, the people who are bullish, Prashant, tell me that, yes, there are select pockets of froth or overvaluation or extended valuation, but doesn't mean that the market-wide broader end of the spectrum is looking weak, and there are pockets which look extremely attractive even now with the Nifty at 20K. What is your sense?
I agree with this latter assessment that you're saying. Broader markets have pockets of froth or euphoria or whatever term you might want to use, but at the larger cap level, which makes up most of the market cap. Yeah? So if you look at Nifty, which is obviously the largest 50, but even if you look at BSE 500, nearly 80% is, or 75-80% is defined as large cap. So not so worried about these large cap dominated or heavy indices. But yes, small cap in general has had a torrid run over the last 5 months from the low of March 28. As of yesterday, at least, it was up some 48% or something. That if you were to take a simple average with 100 trading days in between or thereabouts, almost 0.5% a day kind of increase. Even if you were to do it more mathematically correct and take a compounding, I think it would come to somewhere around 0.3, 0.4 in between that range. That was almost every morning you wake up and you'll expect to see a small cap outperforming the large cap by 0.5% or so. So large caps haven't gone anywhere over the last. I mean, they've just given a reasonable 10%, not even year to date is like single digit returns. It was the mid and small caps, particularly within small caps, also not fair to generalize across board. The micro caps are even crazier. And but you have to look at sectorally also. There are certain small cap sectors, and be it small, large, medium, they haven't gone anywhere. They're, yeah, despite I would say reasonably good fundamentals. Reasonably good meaning growing at double-digit pace, which is the long-term trend line growth. Yeah, but the more deep cyclical you are, where because of the cyclical element, the earnings growth in the near term is very strong 20, 30, 40%. So that doesn't change the long term trajectory of the company, still remains low double digit kind of growth, just as other companies are going. But because the near term is very strong, these companies have gone to almost astronomical valuations basis of extrapolation of that near term strength. So if near term is growing at 25, 35%, if you obviously extrapolate that to 10, 20 years, you can almost justify any valuation.
That's true.
So there is an extrapolation of in this deeper the cyclicality, the greater the extrapolation, I would say. The higher the leverage that these stocks have, the higher they've rallied, and the weaker the governance, the greater the return they've provided. So deep cyclicals leverage poor governance. If you form a index of such companies, uh, that would have returned over the last 5 months over 100% or somewhere around. Yeah, small caps, obviously. So small micro cap, deep cyclicals, leveraged, and poor governance. Yeah, that's up more than 100%. I think some point you are to see that correct.
Yeah, maybe this is the start of that, because today, for example, a clutch of these stocks which have gained quite tremendously in the last few months are showing some signs of weakness. Now, Prashant, sorry, just a thought around here. Some of these pockets, let's say private railway companies or defense companies, their growth rates are looking good. Their capex seems to be coming on stream at various points of time in order to enable growth, not just for the next 2 quarters, but maybe for the next few quarters. And the book to bill ratio seems to suggest that they'll be able to execute this for the next few quarters, not just one or two. What do you do in such scenarios wherein the valuations have run, crazy, if you will, but there is promise of growth?
No, certainly. See, even from here, it is very likely that a small proportion of these names would still end up delivering decent returns. But if you think of similar such time periods in the past, let's take the last hyper cycle for the deep cyclicals. That was the 2003 to 2008 time period. So be it road builders, be it any engineering and construction company, any infrastructure company, real estate companies, they all went ballistic. One way, rocket. Yeah. Now, if you look forward, in some of these cases, the fundamentals didn't play out as they were anticipated in 06, 07 time frame. There's all the rational justification for why those fundamentals should play out that way. For example, in case of real estate, there are a billion four going to billion five largest population. These are all going into nuclear families. They all would need houses. There is just so much land in the country, and so the demand was uninterrupted and super strong. That did not play out fundamentally going forward. In other sectors, the fundamentals might actually have played out, like road construction has continued to move along, maybe sometimes at a bit slower pace, sometimes at a faster pace. But look at what's happened to all those road builders of 2005, 2006 time frame. Yeah, they did, a lot of them are not to be recognized they're not there anymore in the listed space because maybe new competition came in and usurped their territory. Some of them weren't capable to begin with. Some of them were very poorly governed. So several factors have to be taken into account. Just because the sector is going to be very strong going forward, the sector defense spending is going to grow a lot. Now, private sector would have, domestic players would have far bigger role to play in defense spending. Within that, private sector would have a far bigger play. All these are given. But is that entire opportunity going to be captured by the same set of listed companies that are there right now? Remains to be, seen. You cannot get the whole opportunity is being contributed or attributed to the same set of players right now, which may not turn out to be the case.
Okay, thanks for that explanation. The other aspect, Prashant, is that while the Nifty is at 20K, circa 20K, usually at highs, the heavyweight sectors have participated with gusto. This time around, private banks not quite there in terms of participation, IT not quite there in terms of participation, energy not quite there in terms of participation. Is that actually a good sign?
Yeah, for the broader market, what it suggests is there is no rally in the broader market. It's crossed at 20,000, no doubt. But 2 years ago, somewhere in mid 21, also it was at 18,000 plus. Yeah, if I'm not mistaken, it was 18,500 in September, October of 21. So if you think about it, in 2 years, Nifty has gone from 18,500 to 20,000, not even a 10% rise.
Agreed.
So there is no such rally or boom. It's in fact, Nifty is at a lower multiple today than what it was 2 years ago. It's the small cap end and the micro cap end really, which has gone to the heights that they've gone to over the last few months. Nifty has crossed another milestone number, which is 20,000. But there's nothing in terms of the valuation that is, representative of a new high. And hence, some of those things that you mentioned, which is that banks haven't participated, IT hasn't participated, staples haven't participated. They haven't rallied, and maybe that's why Nifty isn't showing much of a rally.
Sure. Could that be something that could course correct? Say over the next 12 to 18 months, could we see the return of these underperforming large caps, relatively underperforming large caps, say banks or IT?
So I would say yes, relatively is the right choice of word that you use. It's not that these guys are down. The banking sector is up. IT sector is up year to date, but they are up more modest, mid-single digit, low to mid to high single digits, which is what one would expect in 8 months of a year. You would expect to earn mid to high single digits. That's like earning the time value of money. So nothing negative about that. Not that these guys have been, relative terms, they've been laggards compared to some of the other deep cyclical sectors that we talked about. And maybe going forward, it is possible if there is indeed a correction or a check in these rising valuations of some of the cyclical segments of market, then maybe they correct, and the other sectors, which anyways weren't at the party, they won't suffer the hangover.
True. Prashant, to your mind, I know that the known risks seldom bring down the market per se, but it is a question worth asking, especially to somebody who manages such large pools of money. What worries you now? Is it the valuation piece, and therefore if a valuation correction happens, does that kind of take care of your worries, or do you reckon that what if oil or the interest rates in the US, so on and so forth? What is it that's top of your mind in terms of worries?
So I'll just clarify. So valuation is not a concern to me in the large cap space or in the mid cap space, or I would say even in the small cap space more broadly. There are only certain sectoral.
Okay.
Basically, the deeper the cyclicality, the more those segments have run ahead in my view. And maybe I'm wrong. If the economic environment turns out to be far stronger for far longer, then maybe that these valuations also the stocks would grow into. But that separate point, I'm saying valuation at a Nifty level or as a BSC 500 level is not a concern to us. The other part of your question was, I'm sorry.
So if the valuation is not a concern, what is the risk
What are the
then? Is it
risks?
higher oil
What are the
prices, something
So the
else?
unknown, yeah. So the unknown. See, the market is pricing in the probability of all the known unknowns. Yeah.
Yes.
Uh, so the known unknown. Obviously, before COVID was an unknown unknown. So market wasn't even factoring in, or maybe was factoring in 0.0001% probability of a pandemic hitting. Now, today, the market is what is the biggest known unknown, which is India specific today. It is the elections in 7 months, 8 months time or so. We are already in September, so 4 months plus 5 months, nearly 9 months time. We'll have election outcome, 8 to 9 months time. Now, market is assuming a certain outcome with a 99% certainty, let's say. So market today is pricing in only 1% probability of that outcome not playing out.
Sure.
It is a known unknown, but it is markets pricing that probability, right? Now, once the event is behind us, then either the 99% is right, so we would have that outcome, in which case, anyways, 99% was priced in. 1% is not even, half a percent or few basis points in the market. I don't know whether it's 95% market is
Yeah.
pricing in or 9%, but you get the gist, right? If that low single digit probability event were to play out, then obviously market hasn't priced that as an event. Because once it plays out, it no longer is low single digit probability. It becomes 100% event.
Sure.
And then that would be a major shock to the market. What would happen later on remains to be seen, whether it's indeed negative for corporate profitability and all that. That market would have to reassess. But right now, the market is extrapolating a certain uh, future for corporates, for the economy, and all. And that would have to be completely, then market would need time to reassess that and find a new level following that reassessment.
Got it. Prashant, last question. The every global person that I speak to tells me that the real defining piece about India's rise in the last 3 years has been the local pool of money that has come in and stayed, SIP, etc. You guys, and you've been a large global money manager, but you've now opened a domestic shop and you're seeing flows as well out there on the mutual fund side too. But my question is really about what is your view on global flows, whether through the White Oak route or otherwise. But because I hear enough and more people tell me that they are having conversations with global pension funds, so on and so forth, and people wanting a slice of India, or if people had a slice of India, they want to increase that slice of India. Maybe it happens post-elections, maybe it happens pre, I don't know. But I want your view on what do you think is the nature of global money floating around and wanting to make a destination in India.
So definitely, on the relative terms, India is better positioned today than at any other point in time in my career, in relative terms. Okay. So the last career, meaning whatever 16, 17 years that I've been investing professionally in India, uh, in a relative terms. So 03 to 07, in absolute terms, there was very strong momentum for India, but so was the momentum for China and BRICS and emerging markets in general. Today, India is a standout, an outlier amongst emerging markets. Now, the problem though is a rising tide may lift the boat higher in absolute terms. And that kind of a rising tide was there in 03 to 07 timeframe, where global valuations were rallying, be developed world or EM world. And on top of that, India was one of the eye of the BRICS, and India was getting its more than its share at that time as well. Today, the global backdrop is not so conducive for equities. There are still a lot of concerns. Not that we agree or disagree with those concerns, but the concerns are there. Inflation is declining but not dead. Concerns about US slowdown is still there, whether it goes in recession or not.
Sure.
China has its own set of problems. So if China has such problems and a lot of other emerging markets have problems, then emerging markets certainly not in favor. So neither global equities are in favor nor emerging markets are in favor. India alone is an outlier and hence benefiting in relative terms compared to others. So India, we do ourselves are getting a lot of lot of inquiries from institutions globally that so far had never invested in India as a standalone country, but now want to make India as a standalone allocation. Historically, the way it works is people either for US institutions, the US is the world. So they tend to almost always stay invested in US. Then the first step they take is go international. International meaning Europe and Japan. Then say, okay, we want to invest in emerging markets. So they'll invest in emerging markets as a bucket. And those that were further advanced, they were like, okay, we'll have China, a separate allocation for China. And then few of them also had a separate allocation for India, but far fewer than those for China. So that segment is growing quite rapidly of corporates who are saying, I also want a separate allocation for India.
That's great insight. Okay. Prashant, before we wrap up, I take it that you largely remain constructive and the simple math, of course, notwithstanding, even the near term, barring some hiccups here and there which are unforeseen, you largely remain constructive despite we having seen a rally.
Yes, absolutely.
Okay, Prashant, sorry, I'm not able to hear you. I think we've just lost the audio, but I heard the term absolutely, and I think that's what probably matters, that it remains constructive. I think we've gotten a larger portion of his thoughts out here. So Prashant, take a moment to thank you today for joining us today and giving us your thoughts. Really appreciate your time.